All right, before you scroll away, I want you to hear this carefully. Some of the most successful investors in recent years were also the least informed. They didn't read finance books. They didn't study valuation models. They didn't even understand what half the financial terms meant. And yet, they made more money than professionals who spent decades studying the market. Sounds impossible, right? Because we're taught one simple idea. The smarter you are, the better investor you'll be. But the market doesn't always reward intelligence. Sometimes it rewards behavior. Today we're talking about why the so-called dumbest investors, regular people with little experience, sometimes outperform Wall Street pros. And more importantly, why copying them blindly is one of the most dangerous mistakes you can make. This video is not about encouraging reckless investing. It's about understanding why it works sometimes so you can use the insight without destroying your portfolio. Stay till the end, because the lesson here isn't obvious, and it might completely change how you think about investing. So let's clear something up right away. When we say dumb investors, we're not talking about intelligence. We're talking about retail investors, everyday people, people with jobs outside finance, people investing between meetings or while sitting on the couch at night. They use apps designed to feel simple and exciting. Bright colors, confetti animations, one-click buy buttons. Most of them don't. Analyze earnings reports, study balance sheets, calculate intrinsic value. Instead, they ask very simple questions. What's going up? What's everyone talking about? What stock is trending today? And here's the key thing. They're not trying to be perfect. They're reacting. Sometimes that reaction is terrible, but sometimes it's perfectly timed. Because markets move faster than logic. By the time experts finish debating why something is happening, retail investors have already pushed the price higher. And that's when headlines start appearing. But what you don't see is what happens to the thousands of others who tried the same thing and failed. Here's where psychology comes in. Professional investors don't just invest money, they invest reputation. Every decision is judged. Every loss must be explained. Every risk could cost them their job. So they hesitate. They wait for confirmation. They avoid looking stupid. Retail investors don't have that problem. They don't need permission. They don't answer to clients. They don't care if Twitter laughs at them. That lack of pressure creates something powerful. Speed. They act before fear kicks in. They buy before doubts pile up. They exit before overthinking traps them. Is that smart? Not always. But in fast-moving markets, speed often beats precision, and ignorance removes hesitation. That's why markets sometimes reward people who don't know what should happen, only what is happening. Now let's step away from psychology for a moment and talk about something even more important: how markets actually move. A lot of people believe stock prices move because companies become better or worse. That's only partially true. In the short term, prices move for one simple reason: more buyers than sellers, or more sellers than buyers. That's it. The market doesn't ask why you're buying. It doesn't care if you've done research. It doesn't reward intelligence. It only reacts to order flow. And this is where retail investors accidentally gain power. When thousands, sometimes millions of small investors all decide to buy the same stock at the same time, they create real demand. That demand pushes prices higher. Institutions see it happening, but they move slowly. They need approvals. They need liquidity. They need confirmation. Retail investors? They just tap buy. By the time Wall Street decides whether something makes sense, the move is already over. This is how memes turn into momentum. This is how jokes turn into billion-dollar market moves. Not because retail investors are smarter, but because they're faster. Now, this is where most people get trapped. Because everything we've talked about so far sounds like a winning formula. Follow hype, move fast, ignore fundamentals. But here's the uncomfortable truth. For every viral success story, there are thousands of silent failures. You don't see them. You don't hear about them. They don't post screenshots. They lose quietly. This is called survivorship bias. Our brains are wired to notice success and ignore everything that didn't survive. So when you see retail investor turns $5,000 into $500,000, what you don't see is the 9,999 others who lost $5,000. The blown-up accounts. The people who quit investing entirely. The market didn't reward skill. It rewarded variance. Someone had to win. Most didn't. And if you don't understand this, you start believing luck is strategy. That's when people get hurt. Let's be very clear about something. High-risk investing is not a shortcut. It's a multiplier. It multiplies gains, and it multiplies mistakes. When volatility works in your favor, it feels genius. When it doesn't, it feels personal. Retail investors who win big often take risks that are mathematically unsustainable. They survive once, not forever. Markets don't punish people immediately. They punish them eventually. That's why copying reckless behavior without risk control is one of the fastest ways to lose everything. The same fire that warms you can burn your house down. So if reckless investing is dangerous and blind copying doesn't work, what do smart investors actually do with this knowledge? They don't ignore retail behavior. They study it. They ask, where is attention moving? Where is money flowing? Where is momentum building? But they pair that with discipline. They limit position size. They accept being wrong. They think in probabilities, not predictions. And most importantly, they play the long game. Because real wealth isn't built in one lucky trade. It's built through consistency. Retail investors win sometimes. Disciplined investors win over time. So yes, the so-called dumbest investors do win. But not because ignorance is powerful. They win because markets are emotional, inefficient, and driven by human behavior. Your edge is not copying recklessness. Your edge is understanding why it works sometimes and why it usually doesn't. If you remember one thing from this video, remember this. Luck feels smart in the moment. Discipline feels boring until it compounds. If this video helped you see investing differently, subscribe to Just Finance and comment below, what's the riskiest trade you've ever made and what did it teach you?